Hello, everybody.
And it would be just so shocking not to get that happen just as we would put this on. But anyway, it's the abbreviated edition of the Friday
Yes.
Live.
Yeah, this is supposed to be Fridays.
Yeah. And then we, again, because of scheduling conflicts, we are here on a Tuesday, my favorite day of the week. According to Carrie, it's her favorite day of the week too. That's what I got on. That's what I got from you from.
Did I say that?
Yeah, you did.
No, I did not.
Is Tuesday your favorite day of the week?
I'm not crazy about Tuesdays.
No.
No.
I think Tuesdays are. I don't know. Tuesdays. I don't know. Does everybody like Tuesday? I just want to know from anybody else out there. Is Tuesdays like a favorite? It's like. I guess it's the Monday. No, I guess the momentum starts building like Wednesday.
Yeah, like Wednesday's middle of the week. Thursday's day
You can tell her smile starts getting bigger as we get to like Wednesday at about 3 o'clock.
Yeah.
Things start changing. But anyway, why are we here today? What are we doing? I don't know. No, we actually do know.
Yes, we do.
And the old.
I know.
I gotta stop doing that. It's a habit I have. I always see that. So I fit you with papers. But anyway, we all have quirks that we have to work through.
Yeah.
But anyway, let's get into the details of why we're even here today.
Yeah.
Because I think there's this, like if everything else isn't crazy enough, we're gonna get into a topic that makes people like not understand things quite well when it comes to like real estate. I mean, what's going on? Why? Specifically today, we'll be dealing with the Fed rate. They cut it. The Fed cut their rates a whole 0.5%. But yeah, it's exciting. It's exciting if you have credit cards. That actually affects it right away. But why mortgage rates kind of went up in contrast to the Fed taking a really drastic approach to Fed fund change. We're going to get into the details of that and why that's happening. Why is it that we're really getting into a time where it's like the craziness? It's crazy times all over. What do you guys think? How's everybody doing out there? Well, we're going to be left and right again. TikTok on the left. So if we're looking there, Facebook, if you have a question, we could sure answer it.
Let us know, yeah.
Right? And obviously, appropriate questions will be answered.
Yes.
Yes. So anyway, let's get into it, Carrie. What do we have going on? Sweater weather. You want to talk about that?
Oh yeah.
Because that's up your alley.
I love sweater weather. This is my favorite season, so.
Fall?
Yeah.
I can't stand this time of year, but anyway.
No.
I don't want to spend too much time. I kind of like those long-winded in the opening.
Okay.
Long-winded in my opening, but the big thing is what is going on with Fed rates and why mortgage rates have not necessarily correlated with affordability in terms of housing prices. So let's get into why that is happening and what that means for home sellers as well as buyers.
Yes. So I do have like a couple questions to ask you about.
You got like a slew of questions.
I have a lot of questions.
It's a lot.
Are you ready?
Yes, I'm ready for the improv. I didn't get the questions in advance either.
So my first question is, how do long-term mortgage rates differ from the short-term rates influenced by the Fed?
Well, I mean, a lot of it's economically based. So what happens is, while we're talking about the Fed fund, and my thing is they differ in terms of demand, okay? Because the Fed fund rate is the rate that basically banks are given to lend out. The rates are usually based on a spread between the Fed and the 10-year Treasury predominantly. There's also some short-term, like 2-year Treasury, 5 years, and then there's even goes out to 20 years, the 10-year Treasuries. So the big thing is like when it comes to like this spread, it really bases itself on what the economic climate is. So a lot of times, like if the economic climate short term is very bearish or not very good, you'll see short term rates generally come down. And then the long-term rates will, depending on all things considered, sometimes they'll correlate, and it's when they become inverted, or like you start seeing like what we've seen over the last year, which is like short-term rates really pop up, and the 10-year Treasuries go down. But really, it's setting the barometer for the economic impact of where the sentiments are as far as the general economy. And there's this is an odd time, so there's a lot of differing opinions on this. And I will because it is opinionated. There's opinions. Yes, there's some facts out there. Which ones are true or not is really a gauge that you'll have to make on your own. I'm not going to say which, obviously the things reported, and what those things are reported. As far as like what you see on the news and what the reality is, sometimes there's a big difference.
Yeah.
And you may have to move my car. She's big on that face.
Okay.
See if if he can get out. I think he should be able to.
I think he could.
Yeah, he's
But
good.
anyway,
He's good.
we have always parking related things.
I know. He's a pro. He is.
You guys are hoping so. But anyway, so what is going on with the Fed funds rate is basically they have the short-term rates are definitely influenced by the Fed. So let's see what happens next. I don't think that you guys particularly going to care for knowing what that's all about, but we're going to find out more about why this is impacting mortgage rates more than anything else, because that's what we're going to do next.
Yes. So, what role does the bond market, particularly the 10-year Treasury yield, play in determining mortgage rates?
So, I mean, that's the basis for the banks peg their as a norm, peg traditional 30-year loans to the 10-year Treasury note. It's a long-standing practice for banks that, and because of the way the spread is, because they borrow money from the Fed, so if they have to borrow at an increased cost, they have to pass that cost along in mortgages to make a profit. So that's the number one role, is the spread. Okay, so the interesting thing is why this is impacting, why the short term, it seems like things have kind of went a little awry, because a lot of people were expecting a Fed rate cut and expect corresponding 30-year fixed rates to move down as well. That hasn't happened. I don't know if we get into why, but yeah, it does say that. But there's some reasons for this. One of them being where the demand is being set in treasuries, and that's something I think we're going to continue on the line. So we could kind of like, I'm going to lump this in with this particular.
Okay.
So the mortgage rates are rising, and it's because there's differing opinions. The selling of bonds creates yields, so people are dumping bonds faster, 10-year treasuries faster than at any point in the last several months. So while people were picking them up in September after the Fed rate cut, because there are some economists who are not convinced that we've stemmed inflation far enough. And where we're kind of in this unusual time, because we are running a $35 trillion deficit. And I said this, and if you've been watching this before, and you've watched this before, I talked about this before, that they could not keep rates, the Fed fund rate, where they were keeping it, because of the fact that banks were having a difficult time, and now because their reserves are held in 10-year treasuries. What's going to happen next? Like, what is going to, if they don't lower the Fed fund rate, because banks have on their books treasuries that are at 2.5%, 3%, 4%, and the depositors have to be given higher interest rates to keep deposits in the bank. And this has been a problem that I said would come to this, where they'd be forced, and maybe prematurely, that they're not going to be able to solve inflation like they want to. And there's some economists out there who don't believe that that rate of cut was required. But I'm going to tell you, it probably was required. If banks wanted to stay solvent, there's what the news says, and there was a little bit of a liquidity crisis. You saw banks go out. There's been a liquidity crisis in the banks overall. I mean, it's not publicized that much, but it's there. And what happens is when that Fed fund rate starts peaking up, and they have depositors, and they basically every month that the Fed fund rate stays high or elevated, they are holding their reserves. So like when you make a deposit in the bank, they purchase safe assets like 10-year treasuries to ensure that their money that they keep on reserves has some nominal interest to gain on it. And when that disappears, and you have this, what I call a very high Fed fund rate and a high 10-year treasury, you basically are taking losses every month, because they got to pay. They got to pay out 4 or 5% on deposits, and only collect 2, 3, 3.5 on 10-year treasuries, which they hold in reserve. And this has been a problem that I think has kind of panned out over the last year. And during the banking, obviously several banks closed because reserves could not be met because of this being a problem. So I do think that when it comes to mortgages, though, and the rate rise, is that I don't think all the sentiment is there that inflation long term is going to be solved in a way that makes investors comfortable. That's really the truth. I think that, whether we, maybe it's not spoken about as much, but I think one of the things that you have to say is it or isn't it a problem for mortgage rates to rise once again? It's based on the fact that investors are hedging that inflation is not over, and I think there could be some truth to that. But it's not going to happen. It's not going to happen anytime soon. Where I think we're going to head off inflation long term, and you're seeing that play out in another asset classes like Bitcoin again, breaching the close to 67,000 today. There's people who aren't having much faith in whether or not we're going to be able to cure the inflation bug that's plagued us for the last, pretty much for the last 3 years.
Yeah. All right. So the next question is, how does inflation impact mortgage rates even when the Fed is cutting rates?
Investor sentiment. Institutional investors is basically, and this is, one of the big warning bells was that even with Fed's cutting rates, it's the appeal of American debt. So you have to appeal to international interests, and that could be a problem. I don't know, like if we're not getting people to purchase bonds at increasingly lower rates, the rate obviously rises because there's no interest in holding U.S. treasuries. And while you can cut the Fed rate all you want, if there's a little bit of lack of faith in the fact that inflation's under control, holding debt in the amounts that we do may present itself a few problems down the road. Now that doesn't even include it. It doesn't matter who's in office either, because this is a problem that either one or the other will inherit. $35 trillion is significant. I've said this before in other lives. We've done this before. I think it's significant in terms of what it means to 10-year treasury. So you have to have an appetite for the types of debt we're carrying, and people. I don't think it, maybe not as much nationally or internally in the country, but outside, we do appeal to a lot of international interest when it comes to 10-year Treasury notes, which helps you keep your mortgages low. It's not something the Fed decides, guys. And that's one thing that I think that's the mistake people make. Oh, the Fed cut rates, that means mortgage rates are going down. We've repeatedly said this, that's not necessarily a correlation between one and the other, because the 10-year Treasury is not the Fed fund rate. And in general, they coincide. But does it mean a short term or a long term? I think that's one of the questions we'll get to.
All right. Now, what factors could use mortgage rates to rise despite lower federal fund rates?
Like I said before, I think, it's pretty much reiterating the point before is that investor sentiment in purchasing Treasury, the 10-year Treasury. If the sentiment out there, again, economists feel that the need to say that we haven't hedged off inflation 100%, and they think that it was premature. Some people were very nervous about, frankly nervous about the aggressive 0.5%, but there were things that were showing up in the economy that said things were weakening substantially. And that's where this balancing act is really having a hard time figuring out. The markets are really having a hard time figuring out what is next. And maybe to the regular person out there that's not watching, it doesn't impact you. It impacts you significantly, because I think that with the home affordability thing, prices going on, if you don't get those mortgage rates lower, it's going to really it's definitely dampening market demand. And regardless of whether prices are going up, and a lot of people are saying this, prices are going up. If you're really considering price appreciation of real estate, it has nothing more to do. Yeah, some supply and demand, but when we talk about low volume, the way we're talking about it, it's not like you're getting a high demand environment to say, hey, we're getting more for our house, money for our house now, but the general economics of it could basically, with mortgages, we've said it here before, if we push closer to 7, the market really shifts in the other direction. We had 2 periods last year where the mortgage rates, there were bond sell-offs, and the mortgage rates came up. At one point we were almost at 8. And this is why buyers and sellers who try to time this market out will not have much luck. It's not a luck situation. I think, I just don't think the luck factor here, there's there's a lot of, what I see, obviously, a lot of misinformation about why the Fed cut 50%, that means it's time to buy. Whatever it may be, the circumstances are very subjective, and if you're doing these things to maximize circumstances, the person that's giving you the advice better have some good understanding of what the whole economic picture is, and B, don't expect things to go in this whacked out world when it comes to finance, that it's going to go along the lines of what you would think should happen, because that hasn't happened. It's been just a consistent, a very, very difficult to understand kind of market. And like I said, I think the last live I did, we did the stats, and I had said that it was 2 months last year when those rates came up to near 8, prices started coming down. But there seems to be a benchmark. Anytime the rate drops under to about 6.7 to 6.5, seems to be the turning point where people are ready to re-enter the market. On the other side of that 6.5 to 6.75, it starts slowing down considerably as you move through 7, which is traditionally pretty low. Even a 7% rate for most mortgages, this is what I call a modern day anomaly. That rates even at 7 be considered high, but traditionally it's not. it's not really that high. Even during the 2008 financial crisis, mortgage rates were close to 7. And even though the whole economy was basically in the tank.
So how do external economic factors like global financial instability or geopolitical events influence mortgage rates, regardless of the Fed action?
Well, this is where we talk about the secondary market, the secondary mortgage market, faith in the system. And, that's a tough question because it's like, I don't want to get into, like, there's so many, you talk about geopolitical factors, right? And geopolitical. We're definitely at a very interesting juncture, just historically across the globe. Obviously, there's so many things that are happening at once. Very, very polarized, we have polarized politics here. There's basically polarized politics throughout the world right now. And when it comes to sovereign debt, we're consistently have outspent our ability to, I think the debt now is coming, it's above, I believe the interest payments alone are over $1 trillion debt service, meaning we're not even paying down the debt. It's getting more representative of the total tax revenue that they're collecting. And so these types of risks, they do pose, it's not, I try to keep it like in a way that's like, how do I, people are nervous. Bigger players are nervous that, we aren't going to be able to manage $35 trillion in debt. I think it's fair to say that is, and we depend on international buyers. There's just so many things with that. You could spend 2 hours just on this subject. You have to appeal to other nations to buy your debt. If they feel comfortable with the idea that your nation is moving in the right direction and it's safe, bonds become much more attractive, lowering the rates. That, I do feel that the polarization of things has definitely dampened international demand for bonds. And I think that's part of the problem why mortgage rates haven't come down. Because I do think that some people, we're heading into obviously a very difficult election, right? And I think a lot of uncertainty around what that means will not bring in new investment into holding American debt just because they don't know how that's going to turn out. I have one of these kind of strange feelings going into October that this may be an issue. It's very hard to say, and you have to be careful about what you say and how you say it. This definitely isn't the venue for me to kind of air out what I personally think. But based on the facts that it's a problem. International interest in holding foreign debt is definitely hinges on stability. And I think maybe internationally that may not be, it's more risk, it's more risky than it's been in the past. So geopolitical, the biggest thing about America's debt and the fact that we could borrow as much as did, A, we were the reserve currency of the world, and B, we had a very relatively peaceful political path. It wasn't like we had these, and it's really, and to an outsider looking in, you got to put yourself. If I'm in another country and I'm looking inward, like what does this look like?
Yeah.
And you have to appeal to these people to say, okay, would I take on debt what I'm seeing, or would I not? And this, I'm not going to tell you. It's hard to say because I don't have the sheets of. We don't get a ticker on where the money is exiting and entering into the market on 10-year treasuries. So the geopolitical risks are, and I'd be short-sighted because I don't have those numbers in front of me, but I would say, just based on opinion, it's probably, it's playing a factor. It's playing a role. To the degree, I'll speculate. speculation at that point. I don't want to get into speculation yet because I don't have every piece of information. But the only thing that I can tell you is that the Fed fund rate dropping and 10-year Treasury yields rising, not something that happens typically. Some people say, well, it's built into the price, meaning that people are already priced in the cut. I read that today. I don't buy it. I don't buy it because I think that the half a percentage, for the most part, was considered an outlier when they did it. So I don't know if the markets factored that in. The real question is whether it was a weakness persisted. But I do think that because it's October and I think November is going to be a little crazy, people are just not certain how the next 3 weeks are going to look.
Yeah.
So people will say there may be more risk associated because of that question, which is an interesting question, a good one at that. That's like, that's something you could go into a deep dive into, and I'm sure if I actually had the data in front of me, I probably could make a better call as to what exactly is causing it. But it's not a simple answer there, really not. It's not a simple one-off, but there's a lot of things playing a role in that. Because it's highly unusual, but sometimes it comes into balance later. I think so go ahead, go with the next question.
Yeah, so the next question I have for you is, how does the Fed balance controlling inflation with the risk of stalling economic growth when
Cutting rates? Yeah. Well, the problem where it can stunt economic growth from cutting rates is you get we won't say hyperinflation, but you get stagflation, which is something that they worry about. So if we continuously lower the rates, and then you have a stagflationary environment where you lower the rates and you don't get the appropriate stimulus you're looking for, meaning that the economy is still not continuing to grow regardless of whether you're dropping the rates, which could cause inflation without growth. Usually you want inflation and growth to go side by side, up a ladder together, if it does happen. I mean, obviously growth and inflation's gone this way, and they want to narrow it from here, which is maybe at one point I think it was like 8 or 9% to like here, which is 2. But you want to keep it on a rail. So as long as it's the rail, but the thing is that the stagflation is that it really comes down when you see you don't see the economic growth more than less than 2%, and you still see the inflation rate going to 5-6% core inflation. So it's something that's the risk. That's the risk of lowering rates further. What happens if it doesn't get the desired effect? Which is why they cut rates in the beginning. There was signs that they're showing that the market was slowing. And we talked about, I think there's an old video of us saying the knee jerks. The knee jerking, it always seems to be late. And it may have come, I do think this cut came later than it should have. I think this is something that they should have been talking about, last March. I believe there should have been 0.25% cuts, unless it's really pointing to the fact that the grip on things is not there. Oh God. Don't look. I don't even think it's bad. Something, I don't know. I don't want to read it. But let's get to the fact. Sorry, we're diverting over here. You get some comments. Thanks.
Yes. Thanks.
But anyway, so that's where we are with that. My thing is that we need to. Sorry for the interruption. Yes. We have to sometimes read a comment or two. But anyway.
Yes. I can't read it.
It's good. I have my thing here. I could probably read it, but I don't think it's anything to read.
Really?
No. I mean, I don't think it's horrible, but it's not something I'm going to read on camera. You want to look at it?
No, it's okay.
Jerry World.
Oh, there you go.
Jerry World.
Here we go. You want to see?
I don't know.
Pinch his cheek. Okay. She's not going to pinch my cheek.
Yeah,
Anyway.
that's not happening.
We're not going to be doing that. Anyway, so,
So I do have another question for you too.
yes.
What are the potential impacts of Fed rate cuts on housing demand and home prices?
Well, I mean, that's a multi-faceted question. This is one of the most difficult. I've been doing the stats for years, and one of the things about stats is like you get into the stats and you're like, my eyeballs are sweating. But one of the things when you get the stats, it's like this is hard to make sense of, and we've been doing this a long. I've been doing this all too long, and this is we don't know. I can't say with any degree of certainty. Because I did believe at one point that the Fed rate hikes and the consistent rise in 10-year treasuries and mortgage rates corresponding with that would cause the market to kind of dampen a bit. And that's not, it's such a swing. There's such a pendulum, and this is what I'm not used to seeing in markets like this, right? So if you think of like a swing or a pendulum, like how fast it moves back and forth, something that I haven't seen in the time that I've done this, which you could go week to week based on the rate. You could have I've seen it as much as 4, maybe even 5% difference in home prices over the course of several weeks, and demand could be so. It's like a swing, and like it's not associated with real estate much. I'm not saying you get these big drops and these big rises, but you can get a 4 to 5 to 6% swing in prices just in a span of weeks, which has never happened. It's never happened. I've never seen like the type of volatile market that you see in this environment. And a lot of it has to do with a lot of volume. I mean, there's not a lot of houses out there for sale. So when things do change, it's important to realize that it's very difficult to understand like how it swings so far. And, you have to be smart about how for a seller or a buyer, getting good advice about this stuff is important to know. Because we do the stats, you do them every week, so we pretty much give you as up to date as you can. But I can tell you week to week, there could be, we'll look at those leading indicators. Tomorrow we'll be doing New Jersey.
Yes.
It's tomorrow, correct?
Yeah, tomorrow.
We'll be doing New Jersey, which is always an interesting, New Jersey's accelerated past New York in a lot of instances. And why, like we see shifts, different markets are doing different things. And giving you a concrete answer on that, not easy. Not easy.
No.
Just based on data. So that's where we got with that.
Alright.
So yeah, my eyeballs are like literally sweating.
Really?
Did your eyeballs sweat? No. It's just like my eyelids.
They tear.
My eyelids don't tear.
Oh, your eyelids were.
No, they're not watering. I feel like,
It just feels sticky. I get it.
yes, my eyelids feel sticky. Anyway.
Yeah, so,
Oh, you could invite me as a guest.
can we do it?
I don't even get that. So anyway, what else do we have?
How do expectations...
Oh, we're going to have someone sing today, right? That's a joke. That's the October surprise. We have to have an October surprise.
We
What do you
do.
think?
I do. We have to have one.
You're going to do our October surprise?
It's an October surprise.
Maybe we could
Come
also...
on. That's Gabriella. Hi, Gabriella. How are you? Say
Hi.
hi. She's off camera. She's camera shy. Yeah, she'll be doing live soon. Don't worry. We'll have her out here. You know, she's making all sorts of faces. She can make all the faces she wants. She's a hand for this stuff. She just doesn't know it yet.
I think she would do good on live.
I think she would do too. You didn't expect to be doing it either. Huh.
No, I didn't. I would.
You bought.
Here I am.
Those figures have become synonymous with Prodigy Real
Jazz
Estate's
hands.
the jazz hands.
I know.
That started very early on. And
It was.
we're going to have a big celebration day to get rid of the squeaky chairs.
Yes. Please.
Yes, the
You
squeaky
know
chairs.
when I'm moving.
And these are not the most comfortable things in the world.
No.
But we
That's
have
why
kind
I'm
of a
moving.
small set here, right?
Yeah.
Yeah.
I think we should get a couch. No?
No, then
You know,
everybody will be sleeping at work.
No.
Come in. Oh, we're in Jersey today. Carrie's working on our iPad, sleeping on the couch.
No.
Anyway, so what else we got? That's
Yeah.
it.
Just about.
Good.
My last
Good.
question is: how do expectations about future Fed rate change affect current mortgage rates?
They're going to cut the rate. I believe there's a good chance they cut another 0.25%. I do think. I mean, if everything goes okay, which is a jaded question, in November, I think we should be okay with mortgage rates, with the Fed fund rate coming down a bit. I do think the prevailing circumstance here is that we're kind of like on just a very kind of, how do you say say it without saying it? I don't know. I need a wordsmith here. But it's going to be just a challenging time. And I just think that it's playing a little bit of a role in 10-year Treasuries. Not until this thing is settled out, I think November, is it November 6th? Gab, is it November 6th?
November 4th? What are you talking about?
The election.
November 4th.
I'm sorry. I'll give you. Just to show you all on top of things. It's November 4th? Well, no, I'm November 6th. Yeah, I'm sorry, guys. But don't forget to register to vote. Go out and
Yes.
vote and go pay attention to the issues that matter to you. I hope everybody goes out and enjoys these next fun 3 weeks. Lord knows if anybody thinks that mortgage rates are going to be volatile, we're going to go into time. If you're not anybody that really worries about this too much, it'll be entertaining if it hasn't been already.
Yeah.
Especially if you're looking for memes on TikTok, right? There's
Oh,
1,000 of them.
Yes. Love TikTok with the memes.
Yeah, Carrie's gonna be doing one soon. I'm looking forward to it.
Oh yes, I have to do that soon.
We're not gonna give you a TikTok here, so you can't
No.
say it.
Don't.
We're not. Anyway, that's it.
Yep, that's all the
And that is
questions I have.
one cute photo. Anyway. Gab, you have anything for us? Any words of wisdom to our guest audience? You looking forward to being on camera soon? Come on.
Not at all.
She's going to be on very soon. She's really excited. She's going to tell you all about a new listing down in Manasquan, which is, we began the process there. We were on the shore, guys, for the first time. Wow, it's exciting.
Yes.
To be
Nice.
down, enjoying Kenny said, I don't know. Joanne's grandma style for 10 gifts. I'm not into the whole gifts things.
No.
I don't know what that's supposed to mean.
But no, we're not.
I'm watching it on delay, so this is funny because we're watching, so we can pay attention to the comments. Here comes that Ariana. But anyway, we're gonna call it a day, folks. Thank you so much. Like, subscribe, share, do what you need to do.
Yep.
Check us out across. Oh, YouTube is huge. Go to YouTube. We're doing phenomenal there. We're doing great
Subscribe to us.
on TikTok as well. So
Yes.
keep it up, guys. We appreciate the you guys being part of it.
Yes.
And hopefully you're finding it informative. All right. Thank you so much, guys. Have a great week.
Bye.
We'll see you soon.
Okay.